Welcome to Module 15. What we're going to cover in Module 15 of Accounting 5000 is the second half of Chapter 7. In the second half of Chapter 7, we're going to talk about long-term liabilities. These are liabilities that are due more than a year from now. Now remember our definition of liabilities. These are probable future economic sacrifices we're going to have to pay. These are obligations we'll have to pay more than a year from now. They will use up some of our resources because we'll have to pay out our cash to satisfy those obligations. Typically these are a result of something we've done previously, incurred a debt that we have to pay off in the future, perhaps 2 or 3 years from now. When do we have long-term liabilities? Typically the same thing we had before with current liabilities, except that these are debts for longer periods of time. We may have to borrow money from the bank in the form of a note with a term of more than 1 year, perhaps 2, 3, or 4 years. So we would sign an official piece of paper and the bank would lend us some money for a long period of time. These types of transactions occur very regularly in the normal course of business. Companies incur debt for a long period of time, either in the forms of notes payable or bonds payable. We're going to talk about the differences of those two in just a minute. Let's talk a little bit about why people or companies incur long-term debt. Often the only way to buy a big piece of equipment or a big furniture manufacturing facility or a big plant of some kind is to go out and incur a debt for it, but you don't have the resources to pay for it in the short term. So you want to pay it off over a longer period of time. It's a way for a company to get major assets, but at the same time spread out the payment of on those assets over a longer period of time. Now most companies will use a mixture of ways to get their capital, that we call it, their financing, for these long-term purchases of assets. They can do it either through selling stock, which we're going to discuss in the next chapter, or they can incur debt for it. The mixture that a company uses of debt and capital to finance its long-term goals is called their leverage, their financial leverage. This is the mix of what we call debt and equity financing. Now think back to your balance sheet equation. Assets equal liabilities plus owner's equity. The company is going to purchase those assets with either the liabilities that are on the right side of that equation or the capital that's on the right side of the equation. So the assets tell you what they have, the liabilities and owner's equity tell you how they got what they have through financing or through capital. We call financial leverage the difference between ROI and ROE. Now if you think back a few modules ago, we talked about how to compute ROI, which is a return on investment, and ROE, which is return on equity. So the difference between those two is called their financial leverage. How well are they using that mixture of debt and capital to finance their operation? Companies will use a mixture of debt and capital because of the tax benefits of incurring debt. Interest is deductible as an expense. Dividends are not deductible. No matter how they incur their capital that they accumulate for these purposes, they're going to have to pay some sort of return on it, either through interest on a note or through dividends on capital, because most people who buy stock want the dividends as a return on their investment. So somehow a company is going to have to give their creditors or investors a return. Dividends are not deductible for tax purposes. They're not a deduction, either for financial purposes or for tax purposes. Interest is deductible for both. And remember, a good deduction for tax purposes means that you're paying cash of less because your tax liability is less, therefore your cash flow is greater. So companies like to have expenses that are tax expenses so that they can deduct them from their tax return. One of the major ways companies get funds for capital expansion and for running their firm is through the use of bonds. Now bonds are different from notes. In a note, a company goes to a bank or a financing institution and signs a legal paper and receives cash and owes that legal institution some form of money, some sort of payment in the future. Bonds, on the other hand, are instruments called financial instruments. These are things that are traded just like stock on the exchanges, so that you can buy bonds in a company. Anybody can go out and buy bonds in a firm. You do it through a broker just like you'd buy stock. Bonds are a way for a company to get large sums of money, more than they could get with a note from one person, by borrowing smaller sums of money from a number of people. So they can sell their bonds to thousands of people and still have a large amount of money, but only be paying to smaller amounts of individuals. Bonds are traded, like we said, on the exchanges, just like stock. They usually have a face value of $1,000. Bonds are typically $1,000 bonds. When you go out to purchase these bonds, you will notice that they're listed as a percent. It doesn't look like a percent, but they're listed at something like 98, which means they're selling at 98% of $1,000. In other words, they're selling at a discount. They're selling for less than the face value of the bond. On the other hand, it may be shown as a 102, in which case you would have to pay 102% of the $1,000 to buy that bond, which would be $1,020. In that case, the bond is selling at a premium. Those discounts and premiums are the difference between the stated rate on the bond and the rate that you're actually paying, or the market rate on the bonds. We amortize. Remember, amortization is a lot like depreciation. We write it off over time. We amortize those discounts and premiums over the life of the bond. The book value of a bond then for a company would be the stated value of the bond plus a premium, if it's sold at a premium, or the stated amount of the bonds on face value less the discount, if they sold at a discount. So the net book value of the bonds may be different from the actual face value of the bonds that they've borrowed the money for. So bear that in mind as you go through and talk about bonds. Now, there are all kinds of bonds for sale out there. They're what we call callable bonds. In this case, the bond can be called back by the firm that issued it. In other words, if they sold bonds for $1,000 and they were callable bonds, the company could go to the person who bought the bond and say, "We want that bond back." Most of the time, the callable bonds have what we call a call premium attached to them, which means that if the company decides to buy back the bond, they would have to pay more than the $1,000 face value, perhaps an additional $25 or $50 per bond. Another type of bond you will see is the difference between registered bonds and coupon bonds. Registered bonds, the company keeps a list of everyone who bought the bonds and pays interest to the people that are on the list. Those are registered with the firm. Coupon bonds, on the other hand, have attached to the bond a series of coupons or payments that can be made to the bonds. The investor takes a pair of scissors and clips off those coupons, takes them to the bank, and collects that amount of money each payment period. So when you hear about little old ladies clipping coupons, often what they're doing is taking the coupons off of their bonds, cutting them the little piece that's due that time, taking it to the bank and receiving their money. So there are registered bonds and coupon bonds. There are also debenture bonds and mortgage bonds. Debenture bonds are based on the actual capital worthiness, credit worthiness of a company. There's nothing to back the bonds other than the company's good name. Mortgage bonds, on the other hand, are backed by some asset, typically a building, equipment, or land, and a company has that asset reserved for the bondholders. If they should not be able to pay the bond, they will sell the asset and use the proceeds of that sale to pay off the bond. So it's backed, it's secured by that asset. You also have term bonds and serial bonds. Bonds that are term bonds mean that all the bonds come due in a particular period of time. For example, if you've sold 5-year bonds, those are term bonds, and all the bonds would become due in 5 years. If you'd sold serial bonds for 5 years, typically 1/5 of those bonds would come due each year. This makes it a little easier for the company to pay off the bonds as they come due, as they would only have to pay 1/5 of the total amount that they borrowed each year. Whereas in a term bond, they would have to pay back the entire total at the end of 5 years. And finally, you have something that a lot of investors look for in bonds, which is called convertible bonds. In most cases, a convertible bond would be converted to common stock. There's usually a stated number of shares of common stock for which that bond can be transferred. For example, if you bought a $1,000 bond in a company and it was convertible to 30 shares of common stock, when it got to be worthwhile, you could trade that bond in and receive your 30 shares of stock. You would probably want to wait until the stock went over $33 a share so that you would be able to get your money back. You would be actually making money on that transaction. So those are called convertible bonds. And lots of investors look for convertible bonds in the hopes that a company's share price will increase and thereby making their bond more valuable. Another type of long-term debt you'll see besides bond is called deferred taxes. Deferred taxes occur when a company's tax rate, the amount they have to pay in taxes based on their tax return, is different from the amount of tax they would have to pay if they base their return on their financial income. Remember, there are differences between tax income and financial statement income. A lot of the reasons are due to the way we compute depreciation. As we talked about in an earlier module, there are special tax ways to compute depreciation, and there are book ways or financial accounting ways to compute depreciation. The differences between those two depreciation amounts would be a deferred tax. Sometimes these get to be very large amounts of money because a company wants to defer their taxes as far into the future as they can. Again, based on present value, if you think about the idea there, the less you have to pay now, the less it'll be worth in the future. So they try to defer as many taxes as they can. Now, most of the deferred taxes are what we call temporary differences, because no matter what depreciation method you use, you will eventually take the same amount of depreciation over the life of an asset. But the problem is that most companies continue to invest in assets. They buy more and more assets, so it never really catches up. So as you can see in that last bullet on the slide in front of you, one of the things that's facing the FASB, the Financial Accounting Standards Board that sets the accounting standards, is the question, should these deferred taxes be reported at present value? Should we not report them at what we're actually going to have to pay in the future? That's a question that's come up. It will be debated pretty hotly for the next few years, and you may see a change in the way we actually handle deferred taxes on our financial statements. Some other long-term liabilities you'll encounter on the balance sheet. Companies that have pension plans sometimes have liabilities associated with those pension plans. Pension plans are monies they're going to have to pay to their employees in the future, so that's a liability to them. The same with bonus plans. These are amounts they will have to pay their employees in the future. If these are long-term amounts, they will have to pay them more than a year away, then they will be long-term liabilities. We talked earlier about contingent liabilities. If for some reason a company puts the contingent liabilities on their books and it's a long-term liability, it will show up in the bottom part of the financial statement liability section as a long-term liability. In this case, there's a probable event that's going to occur that's going to cost them money. They think that something's happened that they will probably have to pay for. It's not just a lawsuit that they don't really know what's going to happen. It's a lawsuit or some other event in which they think they were pretty sure they're going to have to pay money. In that case, they put it on their books so that investors and creditors are aware of the liability. The final unusual thing you'll see under long-term liabilities is something called minority interest in subsidiaries. When a company buys a firm, they often don't buy 100% of that firm. So there are people who own the other, say, 5 or 10% of the firm that they didn't buy. Those are minority investors. They're people who don't have a high percentage stake in the way the firm that the company bought. Those are called minority interests. And those are often shown as liabilities on the balance sheet under the long-term liability section. Again, this is another area that the FASB is debating. Should this be a liability? Is it a negative owner's equity? Should it have a particular place on the balance sheet all its own? Again, you may see a change in the way the minority interest in subsidiaries is being shown, but currently you will find it most often under the liability section of the balance sheet, especially in the long-term section. So what we've talked about so far are long-term debt, notes payable, bonds payable, deferred taxes, and some other miscellaneous things like pensions and warranties and bonuses that you will find in the long-term section. Now let's turn to some problems and see what we can do as far as working through some real-life situations. And let's start with problem 9 in your textbook, which talks about bonds. Problem 9 is about the middle of page 258. And it says K Company has issued $1 million face value bonds, 11%, 20 years. They issued them on April the 1st, 2004. They pay interest annually, one time a year, on March 31st of each year. Assume in letter A that the market interest rates were slightly lower than 11%. Would the proceeds from the bond issue have been more, less than, or greater than or equal to that amount? Well, think about that. They're issuing bonds for 11%, but you could go out and invest at a smaller percent somewhere else. So investors are going to be willing to pay a premium for these bonds. They're willing to pay a little bit more to get the better interest rate. So these bonds are going to sell for more than face value because they're going to sell at a premium. Part B, it says, independent of your answer in A, assume that the proceeds they received were $1,080,000. Again, that's a premium. They're receiving more than face value. So to put that in your books, you're going to actually receive cash. So cash is an asset that is going to increase by $1,080. But the bonds payable, the amount you actually owe as a liability, and you increase the liability with a credit, is $1 million. So the difference between the $1,080,000 you received and the $1 million that you owe is your premium of $80,000. In Part C, they ask you to calculate the interest expense that will show with respect to these bonds for the fiscal year ending December 30th, 2004, assuming that the premium of $80,000 is amortized on a straight line basis. So you're simply going to write off that premium in equal amounts over the life of the bond. So the interest payable, the amount that you're going to have to actually pay your bondholders, is the stated rate of interest, the 11%, times the $1 million in bond, which is your principal. And remember now, these bonds go from April the 1st until September the 30th. That's 6 months. So that's 6 over 12 for your time. So $1 million times 11% times 6 over 12 months gives you $55,000. That's the actual cash they're going to have to pay out. But they're going to have to write off that $80,000 worth of premium in addition. Well, there are 20 years on the life of these bonds, but we've only done a half a year. We've only done from April through September, so that's only 6 months over 12. So if we take the $80,000 and divide it by 20, that would be $4,000, but we're only taking half of that, so that would be $2,000. The amortization of that premium, remember we're going to write off that premium, would have the effect of reducing our interest expense because we would be debiting premium on bonds payable, crediting interest expense. If you credit an interest expense, you're reducing it. So it would be the $55,000 in interest payable minus the $2,000 of the premium that we amortized. So their actual interest expense would only be $53,000. To show that in an entry form on your financial statements, you can see that you would debit interest expense, $53,000. You would debit your premium on bonds payable, $2,000. And you would credit your interest payable, because that's a liability, you're going to increase it, $55,000. So that's what the journal entry would look like. Let's do another one like that. Let's look at problem 14, which is another bond problem. It's across the page from that on page 259, about the middle of the page. It says that Howard Stone issued $25 million face amount 9% bonds when the market interest rates were 8.92% for bonds of similar risk and other characteristics. Okay, so that you know now that the bonds are going out at an interest rate that's higher than the market rate. So this is going to be a premium on these bonds. In the first question, they ask you how much interest will be paid annually on these bonds. Well, that's an I equals PRT formula. So you take your principal, which is $25 million, times your interest rate, which is 9%, and they're paying this interest once a year, so that would be a 1. So that means that we would be paying interest annually of $2,250,000. In Part B, it asks you if the bonds were issued at a premium or a discount. Well, we just discussed that they were issued at a premium because the stated rate on the bonds is higher than the going market rate. So they would be issued at a premium. Finally, in 14, they say, will the annual interest expense on these bonds be more than, equal to, or less than the amount of interest paid each year? Well, as we showed in the previous problem, interest expense will be less than the interest they pay because the bond amortization of that premium would reduce the amount of interest expense. So the interest expense will be less than the interest payable. Well, let's do one more problem. Let's look at problem 29. Again, this is on bonds. It's near the top of page 265 of your textbook. On January the 1st, 2004, a company issued $3 million, 10-year, 14% bonds. The market rate was 12%. Note the bonds pay interest semi-annually, which means they pay interest twice a year. On the end of June and the end of December, they're going to mature December 31st, 2013. Using the present value tables in Chapter 6, so we're going to get to use our present value, calculate the proceeds. In other words, what are they going to get for the bonds when they sell them? January 1st, 2004, assuming the bonds were sold to provide a market rate of interest to the investor. Well, what you're going to have to know is that there are two things the investor is going to receive. They're going to receive $3 million at the end of the life of the bonds because they're going to get their money back. Plus, they're going to get payments twice a year of a certain amount of interest. So they're getting two things back, the interest payments over the life of the bond plus the bond at the end of its life. We have to add those two amounts together after we take the present value of them and see what they're actually going to receive in total. So let's see what the interest payments would be. On $3 million, that's your principal, at 14% for half a year, they're going to have to pay out $210,000 each 6 months in interest. How did I get that? I equals PRT. Notice that the interest rate the market rate of interest is 12%. So half of that, which is what they're going to get each 6 months, is 6%. And if it's semi-annually, they get it twice a year for 10 years, so that would be 20 periods. So we're going to look up in our tables the present value of an annuity. And when we look that up at 6% for 20 periods, we get 11.4699. We take that 11.4699 and multiply that by the $210,000 in interest payments. That tells us what the present value of that annuity of interest payments would be worth. It would be worth $2,408,679. Remember, they're also going to receive $3 million in 20 periods. So again, we go to our present value tables for a single sum, and we look up 6% for 20 periods, and we get 0.3118. If we multiply that by $3 million, we get $935,400. So those two amounts are going to be what the investors are going to receive. The present value of a series of interest payments plus the present value of the $3 million at the end of that term. If we add those two amounts together, we get $3,344,079. That's what they're going to receive, the present value of those payments. The next question they ask you, assume instead, so after you've done all that you can ignore it, that the proceeds were $2,950,000. Write the journal entry to record the payment of the interest and the discount, $50,000, amortized on a straight line basis. So if we're going to amortize a $50,000 premium over 20 periods, we would simply take $50,000, divide it by 20, and we get $2,500. Now we know that we're going to pay out cash and interest of $210,000 every 6 months. We know that amortizing that $2,500 is going to increase our interest expense. So we debit interest expense $12,500. In Part C of the problem, if the discount in Part B were amortized using the compound interest method, would interest expense for the year ended December 2004 be more than, less than, or equal to the interest expense under the straight line method? Under the compound method, it's going to be less in the earlier years of the bond's life, and it'll be greater in the later years because the straight line method will give you an even amount, but the compound interest method will fluctuate over time. Well, it won't fluctuate, it will change over time. Lower in the earlier years, progressively being higher in future years. So in those problems that we have just worked, problems 9, 14, and 29, you've gotten an example of how bonds are treated. You may want to review those problems before you go on to the next chapter, because in the next module we're going to begin Chapter 8, looking at owner's equity.